Hey team, I'm Annie from Crypto Avery channel, your go-to finance voice here giving you a market update on January 20th, 2026. Our goal is to keep things clear, grounded, and focused on what actually matters for building long-term wealth in 2026. We're now deep into January, and the market's sending some mixed but important signals. The S&P 500 is hovering around the 6,800-6,900 range after closing recently near 6,797, 6,940 levels, showing resilience but also some recent pullback pressure. On the surface, sentiment feels optimistic. Wall Street's year-end targets for 2026 cluster around 7,500, 8,000, implying solid upside potential. Corporate earnings for Q4 2025 came in reasonably strong overall, with S&P 500 blended growth around 8%, driven heavily by tech. Looking ahead, analysts project full-year 2026 earnings growth in the 13 to 15% range, with tech continuing to lead. But let's zoom in on the underlying picture. Consumer stress is building. Credit card and other delinquencies have risen noticeably, hitting multi-year highs in some segments as households grapple with lingering affordability challenges and softer labor signals. Retail sales trends remain uneven when adjusted for inflation, pointing to a consumer that's more cautious than exuberant. The Fed has been easing, with cuts already in play and markets pricing in a measured pace forward, perhaps 1 to 2 more this year, reflecting a balancing act between cooling inflation and supporting growth. Commercial real estate, particularly the office sector, continues its slow adjustment. Vacancy rates are stabilizing in some areas, with gradual demand recovery in prime locations, though broader challenges persist from hybrid work shifts. Market volatility, as measured by the VIX, has ticked up recently into the high teens, around 18-19 lately, after dipping lower earlier in the month, signaling a bit more uncertainty creeping in compared to the ultra-low complacency we saw at times last year. Valuations remain elevated on forward metrics, so this environment calls for discipline. The classic wall of worry climb is underway, but the worries, consumer strain, policy variables, sector divergences, are legitimate. My approach: stay invested in quality, but consider taking some profits from extended winners, maintain dry powder for opportunities, and prioritize diversified exposure to resilient names. Corrections of 10 to 15% aren't out of the question if consumer data softens further, but they often create the best entry points for long-term compounding. This isn't about fear, it's about preparation and perspective. Markets reward patience and risk management. If this resonates, drop a like or comment. How are you positioning right now? Fully invested, hedging, or building cash? Let's keep the conversation going. Appreciate you being here. Stay informed, stay steady. See you again tomorrow.